Right. So are you ready to like really dive deep into some serious financial wisdom? Because today we're going to crack open Warren Buffett's 2005 letter to Berkshire Hathaway shareholders.
Ooh, yes.
It's 2005. The economy is, humming along, good times, pretty much all around. But Buffett being Buffett with that like signature knack for kind of seeing around corners,
Right.
he's already like spotting some potential trouble brewing on the horizon.
Yeah, you know what's really fascinating about this letter is it's almost like Buffett had this eerie foresight.
Yeah.
He's talking about like record hurricane damage, which, we'll get into a little bit later.
Yeah.
He's actually doing a self-critique of one of his own like costly missteps in the world of derivatives. And he's even got some pretty sharp commentary on executive compensation practices, which just seem to be spiraling out of control at that time.
Right.
And remember, this is 2005. This is years before the financial crisis even hit.
Yeah.
And yet he's already laying out some of the very issues that would end up like contributing to that meltdown.
Yeah. It's like he had a crystal ball or something.
Totally.
Okay, so let's dive into the numbers first.
Okay.
Okay. Buffett, kicks things off by reporting a 6.4% growth in book value per share for Berkshire.
All right.
And some people might think 6.4%, that's it.
Right.
But remember, this is Buffett we're talking about.
Exactly.
He's not chasing those quick returns. This is the long game.
Yeah. He even calls it a decent year, not even spectacular,
Right.
just steady.
Right.
And I think that consistency is really key to understanding Buffett's approach.
Yeah.
He's not interested in those flashy short-term wins. He's all about building sustainable value over decades.
Yeah.
And this letter is like a masterclass in how he does it.
Absolutely. Speaking of building value,
Okay.
Buffett details some of the key acquisitions Berkshire made in 2005.
Yes.
One that kind of jumps out at me is MedPro, a medical malpractice insurer.
Okay.
Now, anyone who knows anything about insurance knows that medical malpractice is a notoriously tricky field.
Oh, yeah. Lots of risk, lots of potential for big payouts.
Huge payouts.
Yeah, and this is where you really start to see Buffett's deep aversion to risk play out.
Yeah.
He's not one to gamble on shaky businesses, so what's he doing getting into medical malpractice insurance?
Right.
Well, this is Buffett. Remember, he sees value where others see danger.
Right.
He's confident in his team's ability to manage that risk effectively and, turn it into a profitable venture.
Yeah.
It's a classic example of his contrarian approach.
Absolutely.
Yeah.
Then there's this story of the Forest River acquisition.
Oh, yeah.
And this one is just pure Buffet brilliance.
It's amazing.
So imagine this. He gets a 2-page fax
Wow.
about this RV manufacturer he's never even heard of.
Okay.
Likes the numbers, likes the management team, and bam, makes an offer the very next day, 2 pages.
Wow. That's incredible.
I wish someone would buy my business idea off of a 2-page pitch.
I know, right?
That's amazing.
It's really a testament to Buffett's decisive nature and his ability to just like so quickly assess a business and its potential. And it's also a great example of his hands-off management style.
Right.
So he buys a company he believes in, and then he lets the people who know the business best run the show.
Yeah.
Any entrepreneur would love that kind of trust from an investor.
Oh, absolutely. Talk about empowering your team.
Right.
He also spends, a good chunk of the letter praising Business Wire.
Yeah.
Which is a company that distributes press releases and, other information.
Okay.
Not exactly the sexiest business.
Right.
But Buffett loves it.
He does. He does. What is it about Business Wire that he loves so much?
Yeah. What's so special about Business Wire in his eyes?
Well, he's a big fan of the founder, Lori Loki, and the CEO, Kathy Barron-Tamraz.
Okay.
And he highlights their just incredible efficiency and focus,
Right.
which really ties back to this core Buffett principle of, valuing knowledge that's applied effectively. It's not just about what you know, it's about how you use it to create real value.
Get things done.
Exactly. And Business Wire, in his view, is a prime example of that principle in action.
Yeah, it's about getting things done, not just talking about them.
Absolutely.
So we've got, these individual stories, but Buffett doesn't just like throw a bunch of random numbers at you in this letter.
Right.
He carefully breaks down Berkshire Hathaway's business into 4 main segments.
Yeah.
So investors can really understand what they're getting into.
He's all about transparency.
Yeah.
He wants investors to understand that Berkshire Hathaway isn't just one thing.
Right.
It's a whole ecosystem of businesses.
Yeah.
So you've got insurance, you've got regulated utility, you've got finance and financial products, and then this huge manufacturing, service, and retail segment.
Right.
He lays it all out.
Yeah.
Gives you a really clear picture of the company's complexity.
Which is not typical for a CEO, right?
Not at all.
Most CEOs are happy to kind of keep things vague and just talk about the bottom line.
Right.
But Buffett is different.
He's got this deep commitment to letting investors see behind the curtain, understand how the sausage is made, so to speak.
Right, right.
And it's totally in line with his emphasis on intrinsic value.
Yeah.
So he believes that you can't truly assess the worth of a company unless you understand its inner workings, its strengths and its weaknesses.
Yeah.
He's giving you the tools to make your own informed judgment.
He is. All right, so let's unpack that insurance segment a little bit.
Okay.
Because that's where things get really interesting, especially in the context of 2005. Remember, this is the year Hurricane Katrina slammed into the Gulf Coast, causing just record losses for the entire insurance industry.
Yeah.
And Berkshire Hathaway was right in the middle of it.
They were.
Buffett estimates their losses from Katrina alone at a whopping $2.5 billion,
Wow.
with another $900 million from Hurricanes Rita and Wilma.
Oh, man, it was a brutal hurricane season.
It was.
And these events really test Buffett's, long-term approach and his focus on financial strength. Because even with these, massive payouts, Berkshire's float remained costless for the year.
Okay, now you've got to explain this whole float concept, because it's one of those Buffettisms that can make your head spin a little bit.
Right. Think of it this way. You pay your car insurance every month, right?
Yeah.
But you might not have an accident for years.
Hopefully not.
Hopefully not. But that money you paid, it's sitting there.
Yeah.
The insurer is using it to invest and make money.
Okay.
That's the float.
Okay.
It's not free money.
Right.
But the cost of using that float is crucial to an insurer's profitability.
Got it. So even though Berkshire had to shell out billions in hurricane claims, they were still able to make enough money on their investments
Exactly.
to offset those costs. It's like having a giant financial cushion
It is.
that lets you absorb those big hits without going bankrupt.
Exactly. And a big part of that cushion comes from Geico,
Right.
the auto insurance giant that Buffett just loves.
Yep.
Geico consistently gains market share,
Yeah.
delivers strong profits, which helps offset losses in other areas.
Right.
And what's interesting here is that Buffett emphasizes Geico's heavy spending on advertising.
Yeah.
So they spent over $500 million on ads in 2005,
Wow.
which, not all value investors embrace.
Right. Some would see advertising as an unnecessary expense.
Totally.
But Buffett clearly believes in the power of building a strong brand,
He does.
even if it costs a lot up front.
Yeah, he's playing the long game, remember?
Right.
Building that brand loyalty, establishing that trust with customers.
Yep.
It's interesting to think about how that strategy plays out in today's world, with all the digital marketing options available. Is brand loyalty as crucial as it used to be?
It's a good question.
Something to ponder.
For sure. Now let's talk about how Buffett approaches mega cat insurance.
Oh,
So this is the kind of policies that cover huge catastrophic events like Katrina.
right.
He uses this really interesting analogy to explain his thinking.
Oh, yeah.
He brings up Pascal's wager, which is this philosophical argument about believing in God.
Right.
Pascal basically said if he believes in God and God exists,
Yeah.
he wins big.
Right.
If he believes and God doesn't exist,
Uh-huh.
no big deal.
Right.
But if he doesn't believe and God does exist well, then he's in big trouble.
Yeah, so he's applying that logic to mega cat insurance.
Exactly.
Saying, look, we don't know for sure if these massive hurricanes are the new normal or
Okay.
just a fluke.
Right.
But the potential downside is so huge
Huge.
that we have to be extremely cautious.
Yeah.
It's better safe than sorry, right? It's a classic example of Buffett's risk-averse mindset.
Yeah.
He's not willing to bet the farm on something with that level of uncertainty.
Right.
He'd rather err on the side of caution, even if it means potentially missing out on some profits.
Yeah.
And this conservative approach to underwriting risk is something he emphasizes throughout the letter,
Yeah.
almost as if he's sensing what's coming a few years later with the 2008 financial crisis.
It's really remarkable how prescient some of his comments seem in hindsight.
It is.
All right, so we've talked about the wins. Let's get into a less triumphant part of the letter.
Okay.
The derivatives debacle.
Ooh, yeah.
This is where Buffett holds himself accountable for a major mistake, and he doesn't sugarcoat it.
He's surprisingly candid about the whole thing. He admits to dithering,
Yeah.
wasting several years trying to sell off Gen Re's derivative operation,
Wow.
which ultimately cost Berkshire hundreds of millions of dollars.
It did.
This section of the letter is a must-read for any leader.
Yeah.
Because Buffett's willingness to own his mistakes and learn from them is like a masterclass in accountability.
It is. He even quotes his partner Charlie Munger,
Yes.
calling the whole situation thumb-sucking, which, I mean, come on, that's just classic Charlie.
Oh, yeah.
It's such a great example of their dynamic.
It is.
Munger's kind of like that voice of reason,
Yeah.
often poking fun at Buffett's quirks while offering up some, like, sage advice.
Yeah, they have a great partnership, that's for sure.
They do. But before we go any further, let's break down what derivatives are
Okay.
and why Buffett disliked them so much.
Right.
So in the simplest terms, derivatives are financial contracts that get their value from some other underlying asset,
Okay.
like it's a stock or a commodity.
Right.
They can be incredibly complex.
They can.
And that complexity is precisely what Buffett hated about them.
Right.
He calls them a maze of liabilities
Yeah.
and criticizes their opacity.
That's right. You can't always see what's going on under the hood.
Right.
And that lack of transparency makes them incredibly risky.
And he's not just being theoretical here. He's talking about real money, real losses.
Yeah.
He mentions a $404 million loss
Wow.
over several years, a stark contrast to Berkshire's overall success narrative.
It is.
But it's a valuable lesson for anyone involved in finance.
Yeah,
Even the Oracle of Omaha can make a mistake,
that's true.
but it's how he handles that mistake that makes him so extraordinary.
Right.
Fault me for dithering, he says,
Yeah.
taking full responsibility.
Wow.
How many leaders do you see doing that these days?
Not enough.
Not enough.
Yeah.
Buffett's not afraid to admit when he's wrong.
Right.
And he's not afraid to learn from those mistakes.
Yeah.
And in this case, his mistake was underestimating the dangers of these black box financial instruments.
Right.
He saw the potential for them to kind of explode and cause widespread damage.
Yeah.
And sadly, history proved him right.
It did. This is 2005, remember?
Right?
Years before the 2008 financial crisis.
Yeah.
That was partly fueled by these very instruments.
Exactly.
It's almost eerie how clearly he saw the warning signs.
It is. All right. So before we move on to Buffett's critique of executive compensation,
Okay.
do you have any thoughts on, what makes this derivatives debacle so compelling for listeners today?
I think it's the combination of Buffett's honesty, his humor, and his genuine concern for the well-being of others.
Yeah.
Like, he's not just trying to make himself look good or protect his reputation. He's genuinely trying to help others avoid making the same mistakes he did.
Yeah.
And he does it in a way that's both entertaining and insightful.
Yeah.
He's a master storyteller.
He is.
He uses vivid language, he paints a picture, and he doesn't shy away from using self-deprecating humor to drive his point home.
He doesn't. All right, let's tackle Buffett's thoughts on executive compensation.
Okay.
Which he seamlessly ties into this manager-owner conflict that was so apparent in the derivatives issue.
Yeah. Right.
What stands out to you here?
Well, this section is just pure vintage Buffet. It's sharp, it's witty, and utterly unafraid to call out what he sees as corporate greed.
Yeah.
So he uses this hilarious example of a fictional CEO named Fred Futile, who runs a company called, wait for it, Stagnant Inc.
Stagnant Inc.
It's brilliant satire.
It is.
Buffett shows how certain stock option schemes can incentivize CEOs to prioritize short-term stock price gains over the long-term health of the company,
Right.
even if the business itself isn't actually performing well.
Yeah, so imagine you're Fred Futile, CEO of Stagnant Inc.
Right.
Your company's stock price is languishing, maybe even going down.
Okay.
You've got these stock options that will be worth a fortune if you can just boost that stock price, even for a little while.
Uh-huh.
What do you do?
What do you do?
You start playing games, manipulating earnings,
Right.
buying back stock,
Yeah.
anything to create the illusion of growth, even if it's not real.
Right.
And guess what? It often works.
It does.
The stock price goes up, you cash in your options,
Yep.
and walk away with a huge bonus.
Yeah. Leaving the company and the shareholders to deal with the consequences.
Ouch. It's a cynical view, but unfortunately it's all too common in the corporate world.
It is. And Buffett's calling it out, shining a light on these perverse incentives that can lead to bad decisions.
Right. He basically argues that CEOs who are rewarded with these fixed price options have an incentive to hoard earnings and buy back stock, even if it means neglecting dividends and investing in less than stellar projects.
Exactly. And he doesn't mince words here.
He doesn't.
He talks about CEOs getting gobs of money
bumps for mediocre or even worse performance.
Yeah.
He even quips that nothing succeeds like failure in the executive suite.
It's so true, though.
It's a sharp critique of a system that seems to reward short-term thinking and self-enrichment at the expense of long-term value creation.
Absolutely.
So he's raising some serious questions about corporate governance
Yeah.
and whether the system is truly serving the interests of shareholders.
Right.
And these questions are just as relevant today as they were in 2005.
They are.
Has anything really changed in the way CEOs are compensated?
Right.
Are companies doing enough to align the interests of management with the interests of their owners?
These are big questions for sure, listeners. We'd love to hear your thoughts on this.
Yeah.
Share your insights on our social media channels using the hashtag #DeepDiveBuffet.
All right.
But we're not done with this letter yet.
No, we're not.
Coming up in part 2, we'll delve into Buffett's contrarian wisdom on minimizing investment returns,
Oh, yes.
his insights on succession planning, and his overall outlook for Berkshire Hathaway. We'll also explore how some of the trends Buffett observed in 2005 have played out over the past 2 decades.
Yeah.
And how his timeless principles remain relevant in today's ever-changing investment landscape.
Stay tuned. Welcome back. Ready for more Buffett wisdom.
I am.
In this part, we're going to tackle one of the most memorable and insightful sections of his 2005 letter,
Okay.
where he talks about how to minimize investment returns. Now, that might sound a little crazy, right?
It does.
Who wants to minimize their returns?
Right.
But trust me, Buffett's got a brilliant point here.
Oh, he really does. He uses this incredibly engaging analogy about the Gottschalks family
Okay.
to explain how frictional costs can eat away at your investment returns.
Right.
It's like death by 1,000 cuts.
Yeah.
You don't see the damage all at once, but slowly and surely those fees and expenses are chipping away at your wealth.
Okay. I love a good analogy. So paint the picture for our listeners. Who are the Gottschalks and what are they up to?
So imagine this incredibly wealthy family, the Gottschalks, and
Right.
they own all of corporate America and every company, it's all theirs.
Okay.
And if they just sat tight and held on to their shares, they'd reap the full rewards of American businesses' earnings.
Yeah.
They'd be swimming in dividends and watching their wealth grow year after year.
Sounds like a pretty sweet deal.
Right, but then these helpers come along
Okay.
and things start to get complicated.
Okay.
So these helpers are like the financial industry's version of those well-meaning relatives
Right.
who offer unsolicited advice at every family gathering.
Yeah.
They mean well, but their constant meddling often does more harm than good.
Ah, the helpers. This is where Buffett's wit really shines through.
It does.
He describes these layers of advisors, brokers, managers, consultants,
Right.
all vying for a piece of the Gottschalks pie.
And it's hilarious, but also a bit terrifying when you think about it.
Yeah.
Buffett breaks it down step by step.
Okay.
First, you've got the broker helpers. They convince family members to start trading with each other,
Uh-huh.
generating commissions, but ultimately diminishing the family's overall wealth.
Right.
It's like shuffling deck chairs on the Titanic.
Right.
You're creating a lot of activity, but you're not actually going anywhere.
You're not going anywhere. Then come the manager helpers,
Oh, yes.
promising to outsmart the market for a hefty fee.
Of course.
And to justify those fees, they often increase trading activity even further,
Right.
which benefits the brokers, of course.
Exactly.
There's a whole ecosystem of self-interest disguised as helpfulness.
It is, and when those manager helpers don't deliver the promised returns, who comes knocking?
Ooh.
The consultant helpers, of course.
Yes, of course.
They swoop in offering advice on how to choose the right manager helpers.
Right.
It's a never-ending cycle of fees and commissions, all eroding the Gottschalks' wealth.
It's enough to make your head spin. And just when the Gottschalks family is about to give up hope,
Yeah.
along come the hyper-helpers.
Yeah.
These are the folks who promise even greater returns if only the Gottschalks pay even more money.
Right.
They've got fancy new titles like hedge fund manager or private equity guru.
Of course they do.
But Buffett hilariously points out that many of them are just manager helpers in disguise,
Right.
sporting a new Superman costume, but with the same old tricks up their sleeve.
Exactly. And the Gottschalks desperate for better results.
Yeah.
They buy into the hype, they pay even more, trade even more, and ultimately end up with even less.
It's a cautionary tale,
It is.
and one that every investor needs to hear.
Absolutely.
Buffett's point is that all this motion, all this buying and selling, all these fees and commissions,
Yeah.
it's not creating any real value.
Nope.
It's just shuffling money around and enriching the helpers.
That's it.
He estimates that these frictional costs can eat up as much as 20% of the earnings that would otherwise go to the owners.
Wow.
Think about that for a second. 20%.
That's huge.
That's a huge chunk of your potential returns going straight into someone else's pocket. So the question is, are you a God rock or a Had rock?
Ooh.
Are you letting those helpers chip away at your wealth? Think about your own investments.
Yeah.
How much are you paying in fees? Are you constantly chasing the latest hot stock tip, buying and selling, trying to time the market?
Right.
Maybe it's time to take a step back.
Yeah.
Simplify your approach and focus on the long game.
I think Buffett would agree with that.
I think you would. It's a powerful message and one that's more relevant today than ever.
Absolutely.
Now let's shift gears a bit and talk about a topic that's always on the minds of Berkshire Hathaway shareholders.
Okay.
Succession planning. Let's be honest.
Mm-hmm.
Buffett isn't getting any younger.
True.
And at some point, he's going to have to hand over the reins.
Yeah.
So how does he address this in the letter?
Well, he's very upfront about it, which is typical Buffett.
Right.
He assures readers that Berkshire's businesses are in good hands with strong managers and a deeply ingrained culture that will ensure continuity even without him at the helm. He's built a company that's bigger than any one person, even himself.
He's not building a personality cult. He's building a system.
Exactly. And he reveals that the board has already identified 3 potential CEO candidates,
Okay.
all of whom are capable and well-respected.
Huh?
He acknowledges that none of them have his unique combination of business and investing acumen.
Right.
But he points out that the investment side can be handled by a separate, highly talented individual,
Right.
just like they've done at Geico for years with great success.
So he's not looking for a carbon copy of himself.
Mm-hmm.
He's looking for the best people for each role,
Right.
regardless of whether they fit some preconceived mold.
Exactly. He's also realistic about his own mortality.
Yeah.
He tackles the delicate question of what happens if his mental faculties decline before his physical health.
Okay.
He acknowledges that it's a difficult conversation to have,
Yeah.
but he emphasizes the importance of the board stepping in and making the tough call when necessary.
He's basically saying, don't let sentimentality get in the way of doing what's best for the company.
Exactly. He even jokes about his own potential for delusion,
Yeah.
saying that he wouldn't want his philanthropic legacy to be diminished
Right.
because his associates were too afraid to show him the door.
It's a remarkably candid and self-aware statement.
It really is. And it underscores his commitment to putting the interests of Berkshire Hathaway and its shareholders above his own ego.
Yeah.
He's not clinging to power. He's setting the stage for a smooth transition.
And just to put everyone's minds at ease, he ends this section with a simple but reassuring statement. I feel terrific.
Classic Buffett, always leaving us on an optimistic note.
Always. Okay, we've covered a lot of ground in this part. What are some of the key takeaways from this letter that you think are most relevant for our listeners today?
Well, I think Buffett's emphasis on long-term thinking, intrinsic value, and risk management are as relevant as ever, maybe even more so in today's volatile market.
Yeah, he's a voice of reason in a world that often seems obsessed with short-term gains and instant gratification.
He also reminds us of the importance of strong leadership,
Yeah.
both in terms of competence and character.
Right.
He leads by example, demonstrating honesty, integrity, and a willingness to learn from his mistakes.
Absolutely. And his critique of executive compensation and the dangers of excessive fees and commissions are crucial reminders for anyone navigating the investment world.
It's about being a discerning investor, not just chasing the latest trends or the highest returns.
Right.
It's about understanding the businesses you own and aligning your interests with those of the company's management.
And it's about recognizing that investing is not a get-rich-quick scheme. It's a long-term journey that requires patience, discipline, and a healthy dose of skepticism.
Exactly. Now, let's move on to Buffett's outlook for Berkshire Hathaway and the broader market in 2005. What were his thoughts on the state of the economy and the future of the company?
All right, so we're back for the final part of our deep dive into Buffett's 2005 letter to Berkshire Hathaway shareholders. And we've covered a lot, from navigating those hurricane force losses to kind of dissecting Buffett's thoughts on everything, from derivatives to executive compensation. But throughout it all, there's this thread of these timeless investing principles that just seem to resonate no matter what the market's doing.
It's true. Buffett's wisdom, it just seems to transcend the ups and downs of the market cycle.
Yeah.
He's got this knack for cutting through the noise and focusing on what really matters.
He does. So as we wrap up this episode, I kind of want to zoom out a bit and consider Buffett's legacy. I mean, this letter, like all of his shareholder letters, it offers this glimpse into the mind of one of the greatest investors of all time, but beyond the brilliant, investment strategies.
Right.
There's this deeper message about how to approach business, how to build a company, how to lead with integrity.
He's not just managing money, he's building businesses.
Oh.
He's cultivating talent and creating this culture of excellence that's almost unheard of in today's world.
It is. Yeah.
And he's doing it all with this incredible combination of humility, humor, and unwavering integrity.
Yeah.
It's a rare and inspiring combination, for sure.
It is. All right. So before we sign off, let's kind of recap a few of those key takeaways that we've been, highlighting throughout this deep dive.
Okay.
First and foremost, there's Buffett's relentless focus on the long term. He's not interested in quick flips or chasing the latest fads. He's in it for the long haul.
He's looking for those rare businesses with durable competitive advantages, what he calls moats, that can withstand the test of time.
Right.
And he's willing to hold on to those businesses for decades, letting their value compound over time. He's like a patient gardener, tending to his investments, nurturing their growth year after year.
It's a powerful metaphor. And speaking of metaphors, we can't forget Buffett's emphasis on intrinsic value.
Right.
He's not just buying stocks based on what the market thinks they're worth today. Yeah.
He's digging deep, analyzing the fundamentals of the business, trying to understand its true earning power and its long-term potential.
He's not afraid to do his homework.
No, he's not. He's not afraid to really understand what he's buying.
Exactly. And he's only willing to pay a price that reflects that intrinsic value, even if it means missing out on some short-term gains.
Right.
He's got this discipline, this ability to say no to a good deal if it's not a great deal. That's a tough lesson for many investors to learn.
It is. It's about having the conviction to stick to your principles, even when everyone else is rushing in the opposite direction.
Yeah.
And that brings us to another key Buffett principle, risk management.
Right.
He's not a gambler. He's a calculated risk taker.
He understands that even the best businesses can face unexpected challenges.
Right.
And he's always prepared for the worst, making sure that Berkshire has the financial strength to weather any storm.
Yeah, he's not afraid to be conservative, to hold on to a lot of cash, even when others are criticizing him for being too cautious. Yeah, but he knows that having that dry powder gives him the flexibility to act when opportunities arise.
Yeah.
And it allows him to sleep soundly at night.
And there's that famous quote, "Be fearful when others are greedy and greedy when others are fearful." That's Buffett in a nutshell.
It is.
And finally, I think this letter really highlights the importance of building a strong company culture.
Absolutely.
It's not just about having smart people. It's about having people who share your values, who are passionate about the business, and who are committed to long-term success.
It's about creating an environment where people can thrive and where excellence is rewarded.
Right.
It's about attracting and retaining the best talent, not just with money, but with a shared sense of purpose.
Yeah, it's about building something bigger than yourself, something that can stand the test of time.
It is.
So if we connect all of this back to the bigger picture, what can we learn from Buffett's 2005 letter that we can apply to our own lives, whether we're seasoned investors or just starting out? I think the biggest lesson is that success, both in investing and in life, often comes from patience, discipline, and a willingness to think differently.
It's about tuning out the noise, focusing on the fundamentals, and making decisions based on sound principles.
Yeah.
Not on emotion or fleeting trends. It's about being a student of the game, constantly learning and adapting. It's about recognizing that even the greatest investors make mistakes.
Right.
But what sets them apart is their ability to learn from those mistakes and come back stronger.
It's about embracing the journey, not just focusing on the destination.
Beautifully put.
So we hope this deep dive into Buffett's 2005 shareholder letter has given you some food for thought, maybe even inspired you to do some exploring of your own.
As always, we encourage you to read the full letter and other resources. You might discover your own deep dive insights. Find your own nuggets of wisdom that resonate with you.
And who knows, you might even find yourself tap dancing to work just like Warren and Charlie.
Until next time, keep learning, keep questioning, and keep diving deep.